Hello, BGS Itmore family. This is Dollar Will, as promised. I finally got around to putting up a video. This is my first video for my channel. Hope to do more, of course. And I want to start this video off by getting everyone introduced to the market that has been controlling wealth in America for as long as we know. This, what you have in front of you is the Dow Jones Industrial Average. And I'm going to zoom in, show you pretty quickly here, if I can get here. Right here is, you can see the box in the upper left there. It has the date in it, 12/31/29. That is 1929 year. We're looking at a chart that goes back, what, probably 100 years. We're looking at a yearly chart. Every candlestick represents a year. And what we have right here is 1929, just before the crash, what we call the Great Depression. So from here to here, that's the hell that we may be facing again. The first thing I want to clarify is everyone knows I'm a technical trader. And what that means is I believe, or we technicians believe, that fundamental data like earnings does not create the price trend, or news does not create the price trend. And I didn't misspeak in that first part. I can show you examples of companies that didn't even make money where the price of the stock goes up. So why a stock goes up or down has to do with, one, being in the right industry and some macroeconomic issues, and two, just popularity. Just the prospect of making money will make someone buy a stock, even if the company isn't presently making money. So I believe, or we technicians primarily believe, that the trend creates the news, as opposed to the news creating the trend, or the price movement creates the news, and it's not the news that creates the price movement. So this is an alternate or opposite approach, if you want to look at it that way. I guess that's what it is, an opposite approach to fundamental investing. And I will admit I am an extremist. I think my views are, I don't think I really represent most technical traders. I think most technical traders do a little bit of both. I believe that either technical analysis works all the time or it's garbage. And so far, it seems to work all the time. All right. So that doesn't mean that we can guess every trend exactly. No, we can get close. We have a lot of tools, and we can get close. And close is good enough. So we have the downturn, what we call the Great Depression, and then from around 29 to around 39 to like 39, 29 to 39, right in there. What I'm trying to figure out, was it 45? It was around 45 when World War II ended. What I'm trying to show you is that even during World War II, the general trend was higher, was up. Even during World War II. That's what I'm trying to show you. No, World War II didn't start in 29, but I got my years off. But you got the general idea with it. Somewhere in the mid 30s to like 45, something like that. That was World War II. You history buffs will razz me about that, but you get the point. You see, the trend kept going. up. It didn't fall. The market didn't tank, not even in World War. Okay. Now I want to show you 9/11. I hear people all the time say that the Twin Towers made the stock market go down. The stock market was already going down. Okay, this right here, you can move your eyes to the upper left, and you can see that now this is 2001 December. This one candlestick represents the entire year of 2001, and you'll see right before it, in year 2000, the market had already started going down, and 9/11 was in the last part of this year, which was already going down. Okay, so 9/11 did not cause the market to go down. It was going down for technical reasons, and it already started its decline. Okay, and right here is the 2009. Well, the bottom of it we call 2009. This was the housing bubble bursting. I don't even like the term bubble, okay, because these pullbacks are normal. And in this case, it was a normal pullback or consolidation, and the price kept moving higher to present day. So this was the housing crash within this Dow Jones Industrial Average. What the Dow Jones Industrial Average is, I'm sorry, I should have said this in the beginning. It's 30 industrial stocks. And so it's mostly manufacturing companies. That's where you're going to find your automobiles, your metals, your home materials, industrial. Anything related to industry is usually going to be in this. It's going to be represented by these 30 large companies. And these 30 large companies they mirror or represent the entire market. We can compare the Dow Jones Industrial Average with the S&P 500, and you'll see these two mirror each other very closely. So 30 stocks can give you a good indication of the health of the entire American economy, just as well as 500 in the S&P 500. Okay. So here we are over here. Now, what you see here with these yellow and red lines, everyone always hears me talk about Elliott wave theory, and I'm going to be talking more about that in coming shows, but I just want to give you the quick on it, why everyone is so concerned about the hell that we're facing in this market, why this time is different. Okay, this is not like the other declines. The only decline in the past that can compare to what we are about to face is the one here in what we call the Great Depression. Okay. Back to Elliott wave theory. Look at the yellow line. That's the support. I have that in there as a support moving average. The values of the moving averages, ignore that for now. We'll get to all that later. How you set it up, or how I set it up. You may choose to do it a different way. There's no one gospel way of how to do this. Okay, so I'm calling this now. And according to Elliott wave theory, prices make a 5-wave pattern, and then the trend reverses or significantly collapses. We're talking 50% or more, sometimes 70, 80%, So we have here, I'll call this wave 1. The retreat down to the yellow line, I'll call that wave 2. The ascent, I'll call that wave 3. Wave 3 continues all the way to where we said the housing bubble burst. So that's the end of wave 3 here. This downturn makes this wave 4, and wave 5, which complete the trend, gets us to where we are now. I'm projecting that red line somewhere around 27,000 on the Dow. Not looking good. That's where it should end. And now, is that exact? No. No. We have other there are other tools you can use to help you, or help us, or that we use to make a more precise call. But the best tool is the good old-fashioned trend line. Okay, and that's where I would just take a straight line and connect these lows. I would do it on the daily chart, or maybe a 4-hour chart, and just connect from, say, 2009, make a support line, and when that line breaks, bells are going to go off everywhere. Now, what we have down below is an oscillator called a stochastic oscillator. I'll get more into that in future shows too, breaking all this down. But for purposes of this theme that we're discussing here, I just want to show you how you can even use these oscillators to show you the 5-wave count. 1, 2, 3, 4, 5. I know this looks very elementary. You're like, it can't be that easy. Sometimes it is that easy. Let's see. And another reason why I like using a year chart, because you can see the cluster of red. It makes it real easy to do your Elliott wave count. The criticism of Elliott wave theory is that the price moves up and down so much. It's easy to get to make a false count. You know, some people would count this and not and count this and this, and maybe count somewhere. People do all kinds of stuff. But once you use a longer time frame, or when you use a longer time frame, it takes some of those spurious moves out, and it gets pretty clear. And especially when you put a moving average below it, you can clearly see. I would look at every time. In this case, the yellow is my support. I would look at times when the price falls below that green, and so now I would ignore the other times when it's not. And that's how I get my wave count. Let's see. Got some other goodies here. Let's see. This is a very good site I got this chart from. It's called Elliott Wave International. You should go there, sign up. They have stuff for pay, but they also have a lot of free information, and you can sign up as a member for free, and they will send you goodies in your email address, and they also have free information to teach you Elliott wave theory, at least the basics of it. Elliott wave theory requires a lot of practice, but they will get you started. And I'll be offering videos, and there are other videos online all over YouTube. If you watch enough of them, you'll find someone that explains things the way you like, that you can understand it. And over time, you'll see the theory play out in chart movement or price movement, and you'll get it. It's not something that you're going to learn in a week or a month. You have to live these cycles and go through the emotional ups and downs, the greed and fear, and you have to control your greed, control your fear, and still be balanced in your analysis of what's going on. So this chart, this was back in 2014. So you can see here, this chart starts this. Now, I didn't do this. This is Elliott Wave International, but it shows they apparently see things the way I do, in that either Elliott wave theory works or it doesn't. So although they're starting this chart at before 1700, they're saying here that there is a wave that began before 1700, year 1700, and this wave is in a channel, a diagonal channel. You have the resistance uh, um, diagonal line there, and you have the support diagonal line here. Inside those two lines, inside that channel, it's a 5-wave pattern, and they've marked Roman numeral 1 here, meaning that somewhere here the price ran up to there. That's wave 1 in Elliott wave theory. Wave 2, it ran here. Wave 3, it touched the resistance, and then wave 4, it touched the support. Well, they're according to them, they're projecting that we're going to touch a run out of steam right around now and come down to this channel support, and that will be wave 4. So that's 1, 2, 3, 4, 5. And wave 5 will complete this trend that's been running since prior to 1700. Now, this is what, according to what they believe on the EWI, Elliott Wave International. And what they did was they took data from what they're saying here is from British stock prices from 1693 to 1784, and then they combined U.S. stock prices onto it. As you study this stuff more, or as I bring more videos to you, we'll be comparing world markets, so you can see how the stock markets of various countries correlate, and then you will over time understand why my name is Dollar Will, because the U.S. dollar and how let's say metals and energy, the things that industrials need, how those things are affected by the movement of the U.S. dollar. Energy and metals have an inverse relationship to the U.S. dollar. I know it's hard to wrap your head around it, but the U.S. dollar falling is actually good for America, and the dollar is going to soon it's going to finish an uptrend, and it's going to start this steep decline, and that's why, in my opinion, everyone is interested in cryptocurrencies, because when the dollar goes through this, what I'm calling a death spiral, it will that decline is going to cause great interest in gold, oil, cryptocurrencies. So that one theory, or that one trading relationship, gold versus energy and metals, is all you need to know. If you master that and pass that down to your kids, that's all you need to know. Anything else you learn will be gravy. If you learn that, how the dollar affects gold and metals and how to read charts, that's all you need to know. Okay. So what they show here is, you come down here, it looks like they're saying they're projecting around 2020 when this trend will be over. Well, it's 2018 now, and I think that this trend is going to end in the first quarter of this year, or sometime in 2018. I don't even need to say exactly when, because it doesn't really matter. We don't get a prize for guessing the exact date. That's just ego, and you try to keep ego out of trading. Use your tools, which we will get into in future videos to show you. Now, I don't have a chart that shows me the price. Well, yes, I do. Right here, this is the 1932 area right here, and if you imagine a straight line right here, you'll see 1, 2, 3, 4, 5. No, wait a minute. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. I bet you put a line right here, or you can see an imaginary line. You put an imaginary diagonal line right here. When that line breaks, this price comes down, we're going to drop big time. Let's see. Well, that's all I got. For now, that's all I got. So now when you see those videos of people telling you that the sky is falling, the earth is, life as you know it is not going to ever be the same. This is what they're talking about. Because the only people who, there's no one alive, or there's no one that was an adult that's alive right now that would remember navigating or surviving the Great Depression. Or if they are alive, I really doubt that they were old enough to know or remember. So we are about to enter uncharted territory. We don't know what's going to happen. So that's why you're getting all of the doom and gloom stories. But if you adopt technical analysis and learn to read charts, you'll be able to maintain some cool. Because in this crisis, if what we think is going to happen happens, your family is going to need you to be calm and profitable. So thank you for listening. I hope to do more videos. I'm going to try to. I hate making promises. I don't know. I would like to ramp up to do a video every day. Maybe something short just to keep everybody focused. I think it's important to at least study on weekends. Everybody, we have folks out there that are very busy raising families and stuff. And I understand you can't, sit and look at these charts every day. And it's not even really necessary to look at it every day, So if you get in the habit of taking a half hour out on the weekend, that should be enough, So later we'll talk about more about Elliott wave theory and what exactly what symbols to trade. Thank you for listening.